Brace, brace, brace. Hi, I'm Max Keiser. This is the Keiser Report. Man, things are looking weird, Stacy.
Right. I like to call this a blizzard dream. We don't know whether there's inflation, deflation, hyperinflation, hyperdeflation. Many of our guests say it's inflation and it's heading for hyperinflation. Others say it's deflation and it's going to head to hyperdeflation, or it's deflation and heading to hyperinflation. So we saw similar when in our early days of Keiser Report during the last financial crisis, and I think it's the same sort of thing today. And one of these days, one of these boom and bust cycles will collapse the whole system. That's my opinion. Whether or not it's this, we don't know. So we're going to look at the information. Everybody knows that house prices are soaring out of control in America, across America. It's amusing to watch your house price theoretically go up $2,000, $3,000, $4,000, $5,000 every day. Used car prices, as Wolf Richter said on a recent episode here, that consumers are willing to pay the increase, that he, as a former auto dealer in that sector, like he's never seen anything like this, nor have any of his contacts. And that's the most important thing, according to the central bank and inflation, is whether or not consumers are willing to pay those increases in prices, right? They don't step away. They keep on demanding the product, even though it's going up in price. And stock markets, of course, continue to hit new all-time highs. So that's the inflation side. Then we have the deflation side of the derivatives, that there are unknown quantities out there.
Well, let me explain everything.
Go ahead.
In 2008, global financial crisis, we had a global credit freeze. Global economy suffered cardiac arrest, effectively died. Mm-hmm. In response, that's called deflation. When you have an event where bonds, for example, become worthless, and you would call that deflation. And in response, the central banks flooded the system with money, fiat money, and they lowered interest rates to zero. And this has caused a lot of bubbles. And because we live in a financialized world where everything is traded and everything's commodified and commoditized and traded on exchange, those bubbles can appear everywhere, including food and energy occasionally. So a lot of that bubble is in food prices, and it goes up and people say, look, inflation. But it would be a bubble in food within the context of a secular deflationary collapse. The reason I can say that with some confidence is that we have not seen any bubble in wages, right? Everything is subject to a bubble except wages, because there is no actual inflation as defined by an accelerated economic activity or business cycle that would precipitate things like rising interest rates, rising wages, et cetera. No, we have structural collapse. We have lots of money printing faster than the system can collapse. For every $1 trillion in bonds that are at threat of collapsing, the central banks will inject $5 trillion worth of fiat money, and the interest rates are near zero. And those who can, the speculators, and those are now the ruling elites of the world, are the speculator kings. They can create bubbles. It could be used cars this week. It could be food next week. It could be islands somewhere in the Pacific the week after that. Those are bubbles within a secular collapse. And ultimately, when the everything bubble collapses, then we have the realization that the economy died in 2008. We just haven't buried it yet.
Right. And that wage inflation story is entered into in this JP Morgan report recently, where they're predicting 3% inflation for the next 10 years. They're outside their peer groups. JP Morgan, Goldman Sachs thinks it's not going to hit 2% at all over the next 10 years, but JP Morgan's predicting it's going to run higher. And it's obviously not because of wages. Wages are not going up, but their income is going up. The ordinary American's income has gone up dramatically in the past year because of all the stimulus, all of the enhanced unemployment benefits, All of that has caused their wages to go up. Americans unleashing pent-up savings could drive up inflation and rattle parts of the market, JP Morgan's chief strategist says. Karen Ward said in an online presentation this week that JP Morgan estimates Americans have built up extra savings worth around 8% of U.S. GDP during the COVID-19 pandemic, when their spending options have been limited. Ward, a former top economic advisor to the UK's finance ministry, said she thought most of this would be unleashed in a spending spree. When combined with Joe Biden's $1.9 trillion stimulus bill worth around 9% of GDP, that is likely to push inflation higher, she said.
Right, as you point out, those aren't wages.
No.
That's income. So the income through transfer payments, through money printing.
Yeah.
Because the economy died in 2008 and it's being kept animated, like an animated corpse with electric shocks, with money printing, and this is causing bubbles. So used car prices are in a bubble, not because wages are growing and that there's inflation and there's GDP growth and there's any hope of paying down the national debt. Those hopes have been dashed. That's never going to happen. But we do have these bubbles within the collapsing global economy, and the acceleration of that crash is increasing, which is now contributing to geopolitical tensions. You've got this new Cold War situation bubbling. That's because the economy died in 2008.
Though it just dawned on me when you said the transfer payments, it could just be a situation whereby, you talk about the geopolitical tensions, and we've talked about the Thucydides trap, and that the conflict emerges when a rising power overtakes a declining power. That happened to Europe in the past as well. So, we could just be becoming more French. Like, more and more people, there's mass deflation across Europe as well. There's a deflationary problem there. But, because wages aren't rising, wages don't go up, but there's huge transfer payments from the government. It seems like markets accept that in some way. Though JP Morgan does point out that the first quarter to 2021 has been the worst bond market since the 80s. So they're suggesting that's the bond market thinking there's going to be pricing in huge inflation. So,
right. Well, the bond signals on the 30-year bond clearly shows a downward trend. It's currently 2% yield on the 30-year, and there's room for it to go to 0.25%, 25 basis points. So we'll see about that in the next 9 months. If U.S. is becoming more like French, then the switch psychologically, in America, you work to take time off. And in France, you take time off, and work is something that just allows you to take more time off, right? It's a completely different psychology. We've lived there for many years. We know how that goes. In the U.S., you get 2 weeks vacation, and many Americans don't take the full 2 weeks. In France, you get 8 or 9 weeks vacation, and that can be stretched out to 12 or 13 or 14 weeks vacation. And that's the psychology, is that work is a necessary evil to take time off.
Well, again, the psychology changes, and that's the thing that central banks in particular worry about, and investors. So we have, as we mentioned, like you have transfer payments that were huge last year, and whether or not a Biden administration will be able to roll that back, it's unlikely, right? Once you're getting all that free money, who wants to take a 20% cut in their pay, their income, essentially? And Michael Burry, the famous hedge fund manager who is a subject of the movie The Big Short, who shorted the housing market when the subprime mortgage market collapsed and caused a global financial crisis. Well, remember, he said that we're in the beginning or the end of the Weimar stage. Like, the end is the last year of hyperinflation. So he's saying, it went for 9 or 10 years, and you saw a lot of inflation and a lot of booming stock markets and booming property markets as the investors, the psychology was changing over those 10 years, getting ready for more and more inflation until it collapses. Their whole faith in it. Investors have put more money into stocks in the last 5 months than the previous 12 years combined. In raw numbers, $569 billion has flowed into global equity funds since November, compared with $452 billion going back to the beginning of the 2009-2020 bull market. Again, obviously there's somebody on the other side selling it to these investors, but a lot of people are flush with a lot of cash. But it's also that psychology that Michael Burry talks about of the Weimar. If you can control this inflation, if you could do something, if it gets too hot, Brent Bernanke had argued they could just stop it in a few minutes by raising interest rates. But whether or not they could do a Paul Volcker sort of situation, as happened in 1980 when he ratcheted up interest rates to near 20%, We'll see.
No, they can't. And stocks are clearly in a bubble. And as a result of all this money printing, transfer payments, and ease of access through apps like Robinhood and others, you've got folks who are getting money from the government and going right into stock market speculation and buying options and going on margin. And the margin pool has never been higher. Not even before the crash of 1929 did you see as much margin on a percent basis than you do right now. It's the highest percent-based margin fueled stock market ever in history. And again, that is a function of a bubble within a collapsing system. When those bubbles start bursting, pop, 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 then you have the recipe for a global conflict, sadly, because there will be no way for one country to survive without taking the resources of another country.
Well, we see that in this final headline here from Bloomberg. And in terms of, Great Depression sort of times and blizzard dreams of negative rates and negative oil prices and crazy stock signals, price signals and stuff like that. Well, we've always had a beggar thy neighbor, right? Every nation, of course, tries to survive the best they can. And that includes the weapon of beggaring thy neighbor. And if you have the US dollar as a reserve currency, if you get to print it, then you can export inflation or import inflation, whichever one you choose. The global middle class shrank last year for the first time since the 1990s, with about 150 million people slipping down the economic ladder. So this is a new study out, and it shows that 150 million people tumbled out of the middle class.
Right. So the rise in the bubbles, like the stock market, are masking the fact that the global middle class is shrinking. It's neo-feudalism, as we've called it before. It's this barbell economy where it's extreme concentration of uber wealth at the very tippity top, and everyone else is essentially hand to mouth and one paycheck away or one transfer payment away from being homeless. And there's absolutely nothing in the middle. But that's by design, by the way, because oligarchs love to oligarch,
Yeah, it's interesting that the lockdown of the economies is really exposing that layer of the Cantillon effect. I mean, we do have a real economy that manufactures stuff and creates wealth, but the financialized economy has grown bigger and bigger and starting to swamp that real economy. And you really see it. That's the heightened exaggeration of that Cantillon effect, when all there is essentially money printing for most of the world outside of, China.
Yeah, the financialization as a component of the economy for 30 years now has grown every single year. And I think it's well over 70% now if you make all the correct adjustments. Anyway, we're going to take a break, and when we come back, much more coming your way. Welcome back to the Keiser Report. I'm Max Keiser. Let's go to Alasdair Macleod of goldmoney.com. I'm an investor in the company. Alasdair, welcome back.
Nice to be back, Max.
Let's talk about inflation, deflation, hyperinflation, hyperdeflation. What's the current thinking?
Well, I think the first thing we need to do is define inflation and deflation. Inflation is simple. It is an increase in the quantity of money in circulation. Deflation is not so simple because it's something that very rarely happens. And overall, it hasn't happened in our lifetimes. What you would look at for deflation would be a contraction in the quantity of money. The effect on prices is an effect, but the real deflation would be a contraction in the total quantity of money. We haven't seen that. Now, I know a lot of people talk about deflation, but what they're really talking about is they see prices maybe falling. But that hasn't happened either. I mean, the prices were falling in the first month or so of 2020 before the Fed stepped in March the 19th, cut the Fed funds rate from 1.5 down to 0, and then the following Monday announced 120 billion monthly QE and a few other bits and pieces. So that was, if you like, for the deflationists, the last deflationary time. Now, having said that, the majority of the money that is created is actually created by the commercial banks, not the Fed. It's important to understand that. Why are the banks creating money? Well, in the last year, they haven't created that much. They have created roughly 4%. I looked at the figures earlier, and I can see that total bank credit up until the end of March was standing at 15.247 trillion. A year ago, it was at 14.694 trillion. So what have they been doing with it? There are three things they can do. They can either puff up asset prices, they can lend it to consumers, or they can lend it to business. Now, the omnibus figure for business lending and to an extent also consumer lending, we will take as the loans and leasing total. That actually decreased from 10,681 billion. It decreased from that to 10,329 billion. Now, that's a fall of about 3%. So what were they doing with the balance? The answer basically is that they were investing in securities. In other words, they were puffing up the markets. So we have an inflation of prices in non-fixed interest securities markets. We now also have inflation, if you like, or the effect of inflation, falling purchasing power for the dollar in commodities, and also, of course, crypto assets, and to a lesser extent, gold and silver. So we are in inflationary times. It's as simple as that. It is possible that the commercial banks will reduce their bank credit. But actually, if you look at the amount of money there is in the system, I mean, this is just crazy. Total bank credit is standing at over 15 trillion. M1, the narrow money supply, is 18.4 trillion. This, in other words, there's more money in the system than there is bank credit. It's just an extraordinary situation. So it is inflationary, and how it affects prices depends really on how that is translated, if you like, into, is it aimed at the consumer? Now, this is a good example, because the expansion of consumer spending obviously drives up prices, other things being equal. What you have is a government which has drawn down on its general account to helicopter money into every bank account of everybody who earns less than $100,000. They've also increased the amount of welfare payments for the unemployed, and so on. Now, what this does is it just pushes money first into savings, and then as the lockdown ceases, that is likely to dribble back into spending. But again, it's not going to be satisfied by an increase in production. So you can see that again, prices will be driven up. So I think it's the Biden helicoptering of money, which is probably the greatest effects on rising prices, translating monetary inflation into price inflation at the moment.
Alasdair, if there's inflation, what happens to the price of bonds? Not the yield, but what happens to the price of bonds during inflation?
Quite simply, they fall, which is why.
Okay, so my follow-up question would be, I'm looking at the 30-year Treasury bond, and it's done nothing but go up. So there's something wrong with this picture. Let me ask you this. It seems that in 2008, we had this huge credit freeze. The global economy came to a screeching halt. It was a massive effort by central planners, the central bankers, to refloat the economy with a massive injection of money, of fiat money. Mm-hmm. And that fiat money is sloshing around the system in the form of bubbles. We see bubbles in commodities. We see bubbles in the stock market. We see bubbles across the spectrum. And this leads some to conclude that we have some inflation. But the arc of history from 2008 to today, and going back even further, is this fall in yield, a rise in bond prices, which is a classic view of deflation, number one. And number two, if you've got this inflation, how come there's no wage inflation, right? So there's two key indicators that tell me that the big picture is deflation. And within that, we've got bubbles from all the money that you rightly point out, there's trillions and trillions of dollars. And because interest rates are at 0%, and because there's no accountability and there's no enforcement of financial regulations, that bubble of cash is moving about, and it creates distortions and it creates bubbles. But that's not necessarily the predominant theme one could call inflation. Alasdair.
Well, it goes back to what I was saying about where is the bank credit going? It is not going into the economy. It is not going into industry. It is going into non-fixed interest securities and fixed interest securities. As far as the banks are concerned, the safest thing of the lot, of course, is US Treasuries. Now, I haven't been following the 30-year bond yield as closely as you obviously have, but I can tell you that the yield on the 10-year Treasury has actually risen quite steeply in recent months. It's a little bit off the top now, but we're talking about something which in February, the yield was just under 1%. It's now, 1.66%. That's a reasonable rise in yield, which basically means a reasonable fall, if you like, in the price of the 10-year Treasury. Now, not only that, but you have to bear in mind foreign ownership of dollars. That is standing at approximately $28 trillion, which compares with a GDP of roughly $21 trillion. So the foreigners they own an awful lot of dollars, and guess where they are? They are in US Treasuries, they are in cash. I think about $6.5 trillion of that is sitting in bank deposits and short-term instruments such as US T-bills. On top of that, you have got investments, portfolio investments in the stock market. Now, they are important because the first people who will feel sensitive to a fall in the purchasing power of the currency are foreign owners of it. And they will demand a higher return in order to stay with that currency. So we are likely to see increasing market pressure on the Fed, which means that they will be fighting to keep the short-term overnight rates at close to the zero bound. Now, this is important because either the Fed responds by raising rates or the dollar tanks. I mean, it's really a binary choice. It's as simple as that.
That's true. You know, you've got the U.S. dollar, world reserve currency. But if there was, again, when you started and you said we need to have a definition for inflation and a definition for deflation, and this, you know, in different minds can mean different things. Clearly, when you've got an economy where the employment participation rate in the U.S. is at some of the lowest numbers we've seen in decades, where the GDP is suffering as a result, the small to medium enterprises are going out of business, the central banks are printing all this money to try to stimulate the economy, and they say, you know, they're fighting deflation. Now, the result is within a crashing economy. Let me put it to you this way, because we've had this conversation a few times. Is there something maybe we need to consider here? It's not really inflation or deflation. What if this is just a massive power grab by the central banks who know that their policies are not working as indicated, but it is making the oligarchs at the top of all of the countries, they made trillions of dollars. Is this not, Alasdair, I'll put it to you this way, a little creative thinking here. Is this not almost, you could call it neo-feudalism?
I think that's actually quite a good description because, I mean, you know, all of us are serfs in this environment. I mean, the policy makers and the policy planners in the central banks, you know, they are going on a course which basically funds the government and enriches the banks. Why does it enrich the banks? Because there is a wealth transfer from money printing, from you, me, everybody else, into the banks and into the government. And we lose out. Now, this is never, ever admitted by the policy planners. Instead, what they do is they say we're creating a wealth effect, because what they do is QE, and the QE is targeted at pension funds and insurance funds. Pension funds, insurance funds sell government debt, treasuries, to the Fed, and the Fed gives them cash through the banking system, which puffs up the bank's reserves. I mean, that's just a balance sheet effect. And the pension funds and the insurance funds are encouraged to invest in riskier assets. And so you get money going into corporate debt, and you get money going into the stock market, into ordinary stocks. And that is the bubble. So
right.
On the one hand, they have the central banks are saying we are creating a wealth effect, but on the other hand, they're taking it away from us through inflation. And the people who are suffering are the low paid, the people who can't respond to this situation of the purchasing power of their wages and their pensions and their savings being taken away from them. They can't respond. But as you rightly say, the people who really benefit are the people who are in the system, the rich, the people who have set up these enormous companies, the Bill Gates of this world and so on and so forth. So that is why you've got this divide actually happening. And it's extraordinary.
All right, we're going to carry this over to a second segment, Alasdair, and we're getting somewhere finally after years. Doug, thanks for being on this Keiser Report.
Thanks. Thanks very much for having me.
Okay, and that's going to do it for this edition of Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank our guest, Alasdair Macleod. Until next time, bye, y'all.